Think about some of the really common and seriously expensive things that pop up in tax codes around the world.
Uh-huh.
One that's almost a given and costs a fortune is how governments try to encourage homeownership,
Yeah.
specifically through things like, the mortgage interest deduction.
Right, that's a big one.
Huge. And just to give you an idea of the scale, in the U.S., back in 2020, that one tax break cost a mind-boggling $125 billion.
Wow.
And here's where it gets really interesting for you. That was over 20% of the entire federal deficit that year.
20%.
So we're talking about a massive amount of money tied to this single policy.
It truly is a substantial investment, yeah. And it really makes you wonder, what's the real bang for that buck?
Exactly.
For this deep dive, we're focusing squarely on the mortgage interest deduction and, well, what it actually does to the housing choices you and others make. We want to look beyond the usual assumptions we often hear.
Right. Our mission for this deep dive is to really dig into the research and understand how these tax breaks truly affect, whether people decide to buy a home.
The kinds of homes they end up buying, the financial decisions they make about housing, and maybe even the prices we see in the housing market overall.
And to get to the heart of this, we've been examining some fascinating work. A key piece is this academic paper. Do people respond to the mortgage interest deduction? Quasi-Experimental Evidence from Denmark.
Okay.
It was published in the American Economic Journal, Economic Policy, back in 2021. The authors, Jonathan Gruber, AMALIE JENSEN, and HENRIK KLEVENE, really provide some compelling insights for you to consider.
And what's so powerful about their research, from what I understand, is this unique opportunity they had in Denmark. Is that right?
Exactly. Back in the late 1980s, there was this major tax reform. It significantly changed the mortgage interest deduction, but, and this is key, it didn't affect everyone the same way. Different income groups saw different changes.
Ah, okay.
What makes this research kind of gold for understanding this issue is that they also have incredibly detailed long-term data. We're talking about the entire Danish population.
Higher population. Yep. So this combination of a big policy shift and this amazing data allowed them to conduct what's called a quasi-experimental study, which gives us some really robust findings for you.
Okay, let's unpack this then. What was the main question they were trying to answer for you, and what might your initial thoughts be on this? Like, what would you expect?
Well, the core question, as you might expect, is whether making mortgages cheaper through tax breaks actually leads to more people becoming homeowners.
Right. Seems logical, doesn't it?
It does. Lower the cost of borrowing, and more people will jump into the housing market. Economists often call this the extensive margin decision, that basic choice between owning and renting.
And it turns out that before this study, the clear evidence on whether it actually works was surprisingly limited for you.
That's right. Actually, getting solid evidence on this particular aspect has been a real hurdle. It's tough.
Why is that?
Well, you need a specific set of circumstances to line up. You need a really significant change in tax policy related to mortgages. You need detailed information about individuals, linking their taxes to their housing choices.
Right, the micro data.
Exactly. And crucially, you need enough time, a long enough time frame to see the long-term effects on whether people become homeowners, which isn't a decision most of you make overnight, right?
Definitely not. So tell us more about this Danish experiment for us. What exactly happened with this 1987 tax reform that you should know about?
Okay, so the 1987 reform was quite broad, but what's really important for this study is how it significantly reduced the tax benefit on negative capital income. And this included mortgage interests specifically for those in the top tax bracket.
The highest earners.
Yeah. Before the reform, this was about the wealthiest 10% of the population. Now, for the middle tax bracket, which was around 35% of people, the reduction in the benefit was less significant.
Okay, smaller change.
And interestingly, for the bottom tax bracket, covering about 45% of the population, the tax benefit actually increased slightly for you.
Increased. Okay, so a really different impact on the actual cost of borrowing, depending on where you fell on the income scale.
Exactly.
Can you put some numbers on that change for these groups so you can really understand the scale?
Absolutely. So the reform led to roughly an 80% increase.
80.
Yeah, an 80% increase in the net of tax interest rate for that top income group.
Oh, okay.
For the middle group, it was about a 30% increase. Still significant, but less drastic.
Right.
And for the bottom group, like I said, there was basically no change in their net of tax interest rate for you.
So really big, distinct changes.
Very substantial and distinct changes, which, as the authors highlight, are perfect for their difference in differences approach.
Can you explain that approach briefly?
Sure. Think of it like comparing, say, two similar groups. One group experienced the policy change like the top earners here, and one didn't, or experienced a much smaller change like the lower earners.
Okay.
You then see if their housing behaviors diverged after the change, beyond any trends they already had. So it lets them compare the changes in housing behavior between these different income groups for you, isolating the policy's effect.
Got it. And the researchers weren't just looking at this policy change in isolation for you, right? You mentioned they had access to a massive amount of data.
Oh yeah, that's a key strength that makes this study so informative for you. They used incredibly rich Danish administrative data. This stuff linked income tax records to detailed housing records
For everyone.
for the entire population over a really long period, more than 3 decades, from 1980 all the way to 2011.
30 years of data.
Yeah. This allows for a really comprehensive long-term analysis of how these tax changes played out for you.
When you say housing records for you, what kind of information are we talking about? And how did they actually figure out who was a homeowner in the study so you can understand the basis of their an analysis? Because that seems tricky.
It can be. The housing register basically provided information on whether a home was occupied by its owner.
Yeah.
To define homeownership, the researchers linked this to individual-level data for you. They had to deal with some complexities, for example, when multiple people lived at the same address.
Like roommates or families?
Exactly. They didn't count children living with parents, for instance. And anyone in a rented property was counted as a renter for their analysis. Pretty straightforward there.
Okay.
For homes occupied by the owner, if it was a single person or a married cohabiting couple, they were defined as homeowners. Simple enough.
Right.
For more complex situations, like maybe unrelated individuals living together, they used tax file information on property ownership, which started in 1987. And they even looked back to see if those individuals still owned property at that same address to figure out ownership in the earlier years for you.
Wow, that's detailed.
Yeah, the researchers went to great lengths to get a really accurate picture of who truly owned their home, which, adds a lot of weight to their findings for you.
Okay, so with this really solid setup for you, the big policy change, the amazing data, careful definitions, what did they actually find? When they looked at whether this tax change influenced the rate of homeownership, that extensive margin decision of owning versus renting for you.
Okay, here's where it gets really interesting for you, maybe even counterintuitive. Their first main finding was a robust zero effect.
Zero.
A robust zero effect of the mortgage interest deduction on homeownership for both middle and high-income households in Denmark.
So even though borrowing got way more expensive for the top group and somewhat more expensive for the middle.
Right. Despite that significant increase in the cost of borrowing for these groups, they just didn't see a corresponding decrease in the proportion of people owning homes for you.
Wow. That is a real challenge to the conventional wisdom, isn't it?
It really is. For decades, a key justification for this massive expense has been the idea of getting more people into homes, right?
Yeah, the American dream idea, or the Danish equivalent.
Exactly. This Danish study really makes you question whether that's actually happening, at least for a significant portion of the population.
That is surprising for you, given the initial intuition. How did they demonstrate this lack of effect for you? It seems hard to prove a negative.
They used compelling graphical evidence for you, very clear visuals. They plotted the homeownership rates over time for the top income bracket compared to those in the income brackets below them, both the middle and the bottom groups.
Yeah, okay.
And crucially, they controlled for age, because obviously homeownership rates naturally change across your life cycle.
Makes sense.
What these graphs showed were remarkably parallel trends. The lines for the different groups just moved together, both in the years before the 1987 reform and in the years after.
There's no divergence.
No noticeable divergence that would suggest the tax change had an impact on your decision to own versus rent. The lines just stayed parallel.
And this wasn't just a short-term blip for you. Like maybe it took time for people to react. They looked at longer time frames as well.
Exactly. Good point. They conducted their analysis over different time horizons for you. They looked at a medium run period from 1980 to 1996, and then a really long run period from 1980 all the way to 2011.
Yeah.
And the result held. They found no significant impact of the tax reform on homeownership rates in either time frame for you. Same conclusion.
They even calculated elasticities for you, right? The economic measures of responsiveness. What did those show?
Yes, they did. They estimated the elasticities of homeownership with respect to the net of tax interest rate for you. And these were tiny, very small numbers, ranging from about 0.002 to 0.008.
Which basically means?
This basically means they're very close to zero. It indicates a minimal or really no responsiveness of homeownership to changes in the tax subsidy for these income groups for you. People just weren't changing their own versus rent decision based on this.
So this really challenges one of the fundamental arguments for these expensive subsidies for you, the idea that they significantly boost homeownership and all the supposed societal benefits that come with it.
Precisely. The study's findings strongly suggest that for the middle and upper half of the income distribution in Denmark anyway, this primary motivation doesn't seem to hold water for you.
Okay, but they didn't stop there, did they?
No, they didn't. Since they didn't see a big effect on whether people buy, the researchers then turned their attention to what happened among those who were homeowners for you.
Ah, okay. So looking at the people already in the market.
Right. What did they find on the intensive margin? Things like the size and value of the homes people purchased for you.
Okay, so the mortgage deduction might not change whether you buy for you, but it might change what you buy.
That's exactly their second main finding for you. The mortgage deduction did indeed have a clear effect on housing demand at the intensive margin.
Oh.
It influenced the size and the value of the homes that homeowners chose to purchase. So, while it doesn't seem to be getting more people into homes, it is influencing the kind of homes people buy.
Which, given the massive amount of money tied up in this deduction.
Exactly. That's a really important distinction for you to consider.
So how did they measure that for you? What did they look at?
For a home size, they looked at the square footage of the properties for you. Pretty direct measure.
Makes sense.
And to capture maybe longer-term adjustments, they focused specifically on households who moved to different homes after the 1987 reform.
Why movers?
Well, the thinking here is that moving gives you a clearer opportunity to make a significant change in your housing consumption compared to just staying put in the same home for you. You're making an active choice.
Right, a fresh decision point. And what did they observe among these movers for you?
The graphical evidence for movers, again, was pretty stark. It showed a clear divergence in the size of homes purchased by the top income bracket compared to those below them, starting pretty much immediately after the reform for you.
A divergence how?
The top group started buying relatively smaller homes compared to the control groups. And this difference actually grew over several years.
Interesting. So the effect wasn't just immediate, it unfolded over time.
That's right. It highlights the complexity, doesn't it?
Yeah.
These adjustments take time.
And they quantified that as well for you, with an elasticity.
Yes, they did. They estimated the elasticity of home size with respect to the net of tax interest rate to be around 9.1 in absolute value for you.
Meaning?
Meaning that as the cost of borrowing went up for the top group, they responded by choosing homes that were roughly about 10% smaller for a given percentage increase in that net of tax rate. So it's definitely more about the choices of those who are already in the market or entering it.
Okay, so smaller homes. What about the value of the homes for you? Did they see a similar effect there?
They did, and interestingly for you, the effect on home value, which they measured using tax appraisals of these movers, was actually even larger.
More pronounced than the size effect.
Yes, the top income group saw a more significant reduction in the value of homes they purchased compared to the control groups after the reform. The estimated elasticity of home value was around 9.2 in absolute value.
Double the size elasticity.
Roughly, yeah. Indicating perhaps a greater sensitivity of home value to the change in borrowing costs for you. Maybe people cut back more on location or features than just pure square footage.
This really seems to support the idea for you that these tax subsidies, well, they incentivize people to maybe stretch and buy larger and more expensive houses. And when that subsidy is reduced, that behavior reverses. People pull back.
Precisely. The tax deduction effectively lowers the price of bigger and more valuable homes, right? By reducing the after-tax cost of the mortgage interest you pay for you. When that effective price goes up because the deduction is smaller, people adjust their consumption accordingly. It's pretty standard economics, but seeing it so clearly in the data is powerful.
Now, beyond the physical characteristics of the homes for you size value, did the researchers look at how this tax change affected people's broader financial decisions related to housing, like debt?
Yes, absolutely. That was their third main finding. They focused on household financial decisions, specifically the impact on indebtedness for you, and they found that the mortgage interest deduction has pretty sizable effects on encouraging households to take on more debt.
Okay, how did they analyze that for you? What data did they use?
They looked at the total deductible interest expenses reported by homeowners for you on their tax returns.
So not just mortgage interest?
No. Importantly, this included not just mortgage interest, but also interest paid on, say, consumer debt and other types of loans, basically. Anything that was deductible under the Danish tax system at the time.
Got it. And what did the data reveal for you there?
Again, the graphical evidence showed a really clear reduction in the total interest expenses claimed by that top income bracket relative to the control group, starting right after the 1987 reform for you.
So they started deducting less interest overall.
Exactly. And this reduction seemed to stabilize over time.
And they put a number on that too for you, an elasticity?
Yep. They estimated the elasticity of interest expenses with respect to the net of tax interest rate to be around Dacus 0.25 in absolute value for you.
Which is even bigger than the home value one.
Right. It indicates a pretty significant responsiveness of borrowing behavior overall to the change in the tax subsidy. People really adjusted how much they borrowed when the tax benefit changed.
That makes logical sense for you, doesn't it? If the tax benefit of borrowing goes down, people are likely to borrow less, which could then lead to them buying smaller or less expensive homes, kind of tying back to what you found earlier.
Exactly. It all fits together. The reduced subsidy makes borrowing more expensive on an after-tax basis. So homeowners in the affected income groups logically reduce their overall debt, likely through smaller mortgages on perhaps less extravagant properties for you.
Okay, this is all fascinating at the individual and household level for you, really detailed effects. But what about the bigger picture? Did this Danish tax reform have any impact on overall house prices in the country for you, like the whole market?
Yeah, this is their fourth main finding, and the evidence here is, well, they label it more suggestive, but it's nonetheless really intriguing for you.
Suggestive how?
They found evidence suggesting that the reduction of the tax subsidy did indeed seem to lower equilibrium house prices in Denmark.
Okay, that's a tough thing to isolate, I imagine, just within a single country for you. House prices depend on so much. How did they try to figure that out?
You're absolutely right. It's very challenging. So many factors influence house prices for you. The researchers themselves noted that there wasn't really enough regional variation in income levels within Denmark to effectively isolate the impact using just within country comparisons.
Right. You couldn't compare high-income areas to low-income areas easily.
Not effectively enough for this, no. So they turned to a cross-country comparison approach for you. They use something called a synthetic control method.
Synthetic control.
Yeah, it's a statistical technique. Basically, they compared Denmark house price trends to a weighted average of similar countries that didn't undergo a similar tax reform around the same time. It creates a what-if scenario.
Yeah.
What would Danish prices have looked like without the reform?
Okay, makes sense. And what did that comparison reveal for you?
Well, their short-term analysis. They looked at the 4 quarters just before, and the 4 quarters just after the 1987 reform showed pretty similar pre-trends in house prices between Denmark and this synthetic control Denmark for you. The lines tracked well beforehand.
Okay, so they were comparable before the change.
Exactly.
Yeah.
But then immediately following the reform, there was a sharp downward shift in the actual Danish house prices compared to the synthetic control.
How much of a shift?
Their estimates suggest about a 12% reduction that could potentially be attributed to the policy change.
12% lower than they might have been otherwise.
Potentially, yes. Now, it's important for you to remember that this is suggestive evidence, as they carefully point out. Cross-country comparisons have their limitations.
Sure.
But it certainly aligns with the other findings, right? If you see reduced housing demand at the intensive margin.
Yeah, if fewer people are bidding up prices for bigger, more expensive homes.
Exactly. If a significant portion of the housing market, specifically the demand from middle and high-income households for those larger, pricier homes, is dampened by the reduced tax subsidy, it's definitely plausible that this would exert some downward pressure on overall house prices for you.
Okay, so bringing it all together for you then, we've covered a lot of ground. What are the big takeaways from this deep dive into the Danish experience? What are the broader implications for, the ongoing debate about these kinds of tax subsidies for housing?
I think the overall implications are quite significant for you, actually. The study strongly suggests that these mortgage interest deductions, at least for the middle and upper half of the income distribution, based on this evidence, seem pretty ineffective at achieving that main stated goal, increasing home ownership.
Great. The extensive margin effect seems minimal to non-existent for those groups.
Exactly. That core rationale, often based on supposed positive externalities of owning, doesn't seem to be supported by the evidence you've heard from Denmark.
But they do have other effects for you, right? They're not just doing nothing.
Oh, absolutely, not doing nothing. They do significantly influence the size and value of homes that people buy and the amount of debt they take on for you.
The intensive margin stuff and the borrowing?
Precisely. And This potentially leads to, well, maybe overinvestment in housing and potentially excessive levels of household debt without necessarily generating those broader societal benefits often claimed for these subsidies.
And it's important to remember, as you said, this was primarily observed for the upper half of the income distribution in Denmark.
Yes, that's a key qualifier. The study couldn't really determine the effects on lower-income households for you because their subsidy didn't change much or even slightly increased.
Okay, so let's try to boil it down for you. What are the key aha moments for you from digging into this research?
For me, the biggest aha for you is that clear disconnect. You have this huge expense, these billions spent on mortgage interest deductions, and yet,
They don't seem to move the needle much on getting more people into homes.
right, at least not for a large chunk of the population studied here. Instead, they seem to primarily incentivize those who are already going own or can afford to own to just buy bigger, pricier properties and, frankly, rack up more debt.
And then there's that hint that they might even be inflating house prices overall.
Exactly. That suggestive evidence on house prices just adds another layer of complexity for you to consider. It really complicates the picture.
It definitely gives you a much more nuanced understanding, doesn't it, of what seems like a pretty straightforward policy on the surface.
Totally.
It pushes you to look beyond that simple assumption that making mortgages cheaper automatically equals more homeowners.
Absolutely.
Yeah.
And it prompts us to ask some pretty critical questions for you, I think. If the main goal isn't necessarily creating more homeowners, at least not for everyone,
Then what is the real purpose?
right, what is the real purpose of these incredibly expensive subsidies? Are the distortions they seem to create in housing size and household debt, are those justifiable?
And what about other places? What might the implications be for countries like the U.S., maybe, which have even larger mortgage interest deductions or just totally different dynamics in their housing markets?
Yeah, those are the big questions. This really makes you think, doesn't it?
It really does. It opens up a lot of avenues for further exploration for you. If you were directing future research, what kind of studies would you like to see following up on these findings?
Oh, good question. I think it would be absolutely crucial to investigate the effects of similar policies, specifically on lower-income households. We need to know if the story is different for them, as this study's findings primarily relate to the upper half in Denmark for you.
Right. Fill in that gap.
Definitely. Also, more comparisons across different countries, countries with varying levels of mortgage interest deductions, different housing market structures, different tax systems that would be invaluable.
See if the Danish result is universal or context-specific.
Exactly. And of course, maybe a deeper dive into the potential trade-offs between these kinds of subsidies and alternative housing policies. Maybe policies aimed more directly at addressing affordability for you.
Okay, so to leave you with a final thought to chew on, could these vast sums of money, billions and billions, that are currently being used effectively to subsidize larger mortgages, could that money be better allocated somewhere else? Perhaps to policies that directly tackle housing affordability for a wider range of people, or maybe address other pressing societal needs entirely.
It certainly gives you something to think about.
Definitely something to think about and explore further on your own.